Hi folks, this is hopefully a reasonably quick video on the settings that are available in the 30-second bot strategy for TradingView. Ahead of time, I'm going to apologize for audio. I had some feedback that the audio is not great. I will obviously try to improve, but I'm limited by the available hardware that I have to do the recording. Hopefully it's not too bad, and you can hear everything clearly, and it hopefully makes a lot of sense as well. Without further ado, let's talk about the settings that are available in 30 seconds. I've taken a screenshot of all the settings just so it's easier to talk about them and see them in the chart. The settings for reference are available by clicking on this little gear icon inside TradingView next to the 30-second bot strategy available there. The first two settings relate to the FVG size. The strategy uses fair value gaps or FVGs to do the entry. We want to make sure that we're not entering in FVGs that are too small or that are the ones that are too big, because the price can retrace deep into that FVG, still provide a valid long or short, but be well beyond the limits of your stop loss. The defaults are the minimum 2 ticks, which means it's roughly half a point in NQ, and the maximum is 100 ticks, which is 25 points in NQ. And this is measuring this particular area. So this FVG was valid for a short because it was only 3.25 points in size. Next, we have the swing sensitivity. One of the criteria for entry is that we need to make a swing high for a short or a swing low for a long, indicating that we've taken some sort of a liquidity that we're using as a reference. And in order to determine the swings, we have, again, two parameters, left and right. Left parameter determines how many bars to the left do we need to go to validate the swing. For example, this was our swing right here. 15 bars would roughly take us 7.5 minutes, roughly somewhere around here. And obviously we don't have a low anywhere close. On the left, we're okay. And on the right, we're counting 9 bars. That would be roughly 4.5 minutes. So somewhere around here. Those parameters determine what is a valid swing. And obviously, the higher the numbers, the more prominent the swing is going to be. One thing to keep in mind is because we are operating on a 30-second time frame, you need to divide it by 2 in order to get, or multiply it by 2 to get 2-minute values. For example, 15 is a 7.5-minute swing to the left and 4.5-minute swing to the right, just as a reference point. Then we have another two settings, distance from the swing. Let's say this was our swing. We want to make sure that the entry is no more than 10 bars or 10 candles from that swing. And we also want to make sure that the price has not gone down or up more than 44 points from the height of the swing. And the idea behind those settings is to limit the setups that are formed way past the swing point, and very likely we could easily retrace beyond the swing, resulting in a loss in that particular case. Next, we have the nearest swing check, which is also in points. And what that does, it tries to prevent entry on bad setups where, let's say, the price is moving higher, but didn't take the entirety of liquidity, and we still have a remaining swing. To give you an example, let's say this was our swing right here, and this was the FEG formed. What it's checking is that we're not too close to the next valid swing in a direction opposite to the trade. In this case, we have roughly 3.25 points. Based on this criteria, it would be okay, but the higher that number, the greater that safety margin is to make sure that you don't have any excess swings there. The next setting is related, which is called max bars for entry. And what it does, it counts the number of bars from the time that the FEG is formed. If the entry is presented within 8 candles, then it can be taken. However, if it takes more than 8 candles to provide an entry, we don't want to enter that setup because very likely the price is chopping around and could very well move in a direction opposite from the trade. Ideally, you want this number to be as low as possible. That, in my experience, provides the highest probability trades, but setting it too low can also mean that you may miss certain setups from trade. Next is we have our take profit and stop loss section. We have the basic take profit, how many points, stop loss, how many points. We also have a setting called Smart Stop Loss Origin. And what it tries to do is it gives you an option to reduce your stop loss by checking how far are you from either the swing, or the other option available there is the FEG, or you can disable it entirely. It'll try to reduce your stop loss, which is 17.5 points in my case, to something smaller like 16 points in the event that the swing high or the FVG edge that is used for entry is in close proximity, and you don't need to use full 17.5 points to place a safe stop loss. You can actually use that edge to reduce the value in order to do that. Then we have the number of contracts to take. It's default to one. So this will determine, how many contracts you want to enter. If you're using NQ, you probably don't want to go beyond one. If you're using MNQ, you can increase the number a little bit to provide you some meaningful setups that are going to give you more than a few dollars of profit. Then we have the trailing stop loss, which is first we have the stop setting, which determines after how many points the stop loss is initiated. And the offset indicates by how many points the trailing offset is going to trail the current price. Now, the offset is a fairly tricky setting, especially when it comes to backtesting, because when you're dealing with historical bars, TradingView doesn't do a very good job of simulating the trailing result. And you'll find that the best results are actually generated with the smallest possible offset, like a quarter of a tick. Unfortunately, in real life, the price actually moves back and forth within the candle, which is something you don't see in back testing. You actually need to use your own judgment and set the offset, I would say, no less than 2 to 3 points. I'm experimenting with higher values and so on, but you often see in real time that a small trailing offset would actually mean that your trades are closed too soon before they have a chance to hit their final take profit, because of the small retracements within the price action as it's moving towards your target. Then we have the entry discount. This is kind of a setting that has so far been a bit of a disappointment, but it is there anyway. What it does is rather than entering at the very edge of the FEG, as is the default string right here, you can actually tell the strategy to enter inside the FEG. And you can do that by saying how many ticks inside the FEG you want to enter, or you can use percentages in increments of 25%. The strategy will calculate the size of the FEG, determine where 25, 50, 75, or 100% is, and set your entry point there automatically rather than relying on a fixed number of ticks. And then related to that, you have original TP, original stop loss. If those settings are not set, it'll apply the TP and stop loss to your new entry point. But if you check original TP or original stop loss, it'll actually adjust the values to be smaller and larger depending on your discount adjustment that you've made. The next setting relates to what happens during the trade itself. One of the things that I've seen is that if a price hangs around in a particular area for too long, chances are it's going to fail. You really want it to start moving in a direction of your trade fairly quickly. We're operating on a 30 seconds, so it's pretty much a scalping time frame. And because we're now going for hundreds of points of profit, we want it to get there very quickly. So to prevent this being chopped around and potential losses, as chopped can often result in a move in a direction opposite to your trade, there is a limiter which indicates how many bars can the trade be active. And if the trade exceeds that number, the strategy will try to close it. And you have two ways of closing it. If you're in profit, you can choose close or you can disable it. If you're in drawdown, which is a second option, you could choose to close the trade right away. You could try to have the strategy set the stop loss to break even and exit for break even, or you can disable that setting entirely, depending on your preference. Next setting is we have the inversion check. Oftentimes, if you work with fair value gaps, you know that the first sign that the fair value gap is going to fail is that if it is inversed, meaning the price closes above the fair value gap. As it happened here, this short FVG was actually inversed. However, inversions on very small FVGs are highly unreliable, and are not indicative of the trade as actually failing. If you're using inversion check as invalidation as a way to quickly close a trade if it's going in the opposite direction, the strategy provides a setting allowing you to set the minimal size of the FVG for it to matter in the case of inversion, which is 8 points in this default. And then you can choose an action, which is closed by default, but you could set it to break even or disable it altogether, in which case the strategy will either try to close a trade right away on inversion at whatever point the price may be, or break-even option will allow you to try to close a trade for break-even, or you can disable this functionality entirely. The last relevant setting is the session time. This is the time during which the strategy will take trades, and in this case, it's from 7:30 a.m. Eastern time to 4 p.m. Eastern time. All the times here are in Eastern or New York time. That is the general limit on the time frame. The other setting, and I'll pull up the full setting bar here for full reference, is actually time limits. During the day, there are various time frames or macros during which price can be extremely volatile and unpredictable and can move ignoring typical PD arrays like FEGs, OBs, and so on. This can often be relating to hour closes, big news releases, and so on. I've made a big collection of times where price action can be unpredictable. And those times are, even though they're within the trading session, they are excluded from being traded, or no entries will be entered during that time. You can always add more of these for your, if you have your own times. So for example, if I don't want entry between 12:01 and 12:05, then I would just enter it in this format. So it's hour, minute, minute, dash, hour, minute, minute, and that'll be added to the mix. If you want to remove any of the times, you can of course remove them, but I would actually recommend, just so that you maintain them for reference, is putting a hash mark in front of it, which will effectively disable that block from being processed. That is a way for you to maintain those times for reference, but not actually have them observed. Lastly, you just have a couple of visualizations, how to render the FVGs and what color, and whether to render the take profit, stop loss, or the sweep lines on the chart to give you some idea of what was the basis of the trade. That's a quick overview of all the settings. Hopefully that's clear.